Okay, so now I want to introduce John Powers and Anat Admati. And Anat's going to lead off and talk about the banking system 5 years after Lehman. So let me just say a word or two about both of them, each of them. So Anat, I really like the fact that her endowed chair is named after somebody I know, the George Parker Professor of Finance and Economics at the Stanford Graduate School of Business, and that's got to be an honor to have that chair. She's written extensively on information dissemination in financial markets, trading mechanisms, portfolio management, financial contracting, and most recently on corporate governance and banking. Since 2010, she has been active in the policy debate on financial regulation, particularly on bank capital regulation, as you will hear. She is a co-author with Martin Hellwig of the book, The Banker's New Clothes, What's Wrong with Banking and What to Do About It. Professor Admati received her bachelor's degree from Hebrew University and her master's degrees, she got 2 of them, and PhD from Yale University. And she's a fellow of the Econometric Society, and she served as a board member of the American Finance Association on many editorial boards, and she serves on the FDIC Systemic Resolution Advisory Committee, a committee thinking about how you resolve a systemic crisis, should there be one, again. John Powers is president and CEO of the Stanford Management Company. Most of you know the Stanford Management Company was established in 1991 to manage Stanford University's financial and real estate assets. Today, SMC and John Powers oversees almost $20 billion in endowment and trust assets and temporarily invested expendable funds and commercial real estate assets. Before joining the Stanford Management Company, he served as the managing director and the director of research at Offutt Hall Capital Management. And earlier he worked at Robertson Stevens as managing director and director of research, as well as on their management and executive committees. He received his bachelor's degree from Cornell and then got his Stanford tags by getting his MBA from the Stanford Graduate School of Business. He serves on the board of McKenna Capital and on the San Francisco Ballet, as well as on the investment advisory board of Google. So we have 2 terrific speakers. As I understand the format, Anat's going to lead off with about a 15-minute presentation, and then John is going to lead the 2 of them in a conversation about it, leaving time to have you enter the conversation at about the last 15 or 20 minutes of the hour. So here you go, Anat.
Well, thank you, John, and thank you, John, for being here. I'm honored to have this opportunity, and I'm thrilled to have John Powers here. I think he wanted me to talk so that he doesn't have to have me ask him what he's going to do about all of this, because I've been looking for people to get involved, investors in particular. So 5 years after Lehman, you just have to open the newspaper. It's not hard to find lots of news related to, in some way or another, to either the financial crisis or to what we might be doing or not doing about it. Of course, today's news, I'm just going home for the night. I sometimes print. I should read more online because I do print a lot of stuff like that. I just said the titles of the things I didn't get to read today, but of course one of them is about JP Morgan Chase, which in the front news quite regularly, often time for getting in trouble, this time for settling with Eric Holder, the same person who said that he's got to think about whether to prosecute a large bank in case it harms the economy. The famous too big to jail comment. Of course, you don't jail corporations, you only jail people. And in the case of JP Morgan Chase, they still have a criminal investigation, but that's really very rare. So most of these suits that you hear about are civil suits that get settled, and the suit settles for money that the corporation pays, which means the shareholders pay. And sometimes it's sort of between shareholders even, because some of the ones getting the money are other investors, pension funds and all. So that's interesting. One of the things here is fact sheet on Jamie Dimon, JP Morgan Chase settlement with the Department of Justice, exactly what's the $13 billion and what is it going to settle and what's in cash and what's in this and that. Other titles from today: jury finds Bank of America liable in mortgage case nicknamed The Hustle. I didn't read that yet, it's just. And then Nordic banks seek to block EU crackdown on capital reporting, and bank balkanization prevails in Europe in the eve of asset quality review. And banks face risk model clampdown in Basel trading book review. These are the kinds of things I read every day. That's been my life. As John said, I came into this expertise from being interested in corporate governance and shareholder activism and these kinds of things, most recently about how you can govern corporations. And then when the crisis hit, and I was also getting interested in maybe microfinance, I wanted to do good, whatever. And then the crisis hit, and I just, like everybody else, got curious about banking. What kind of industry is that? Let me look at that from my lens of governance and contracts and efficiency and regulation, and I wasn't into policy at the time. But when you get there, you ask why did the banks get into all this trouble? Is there anything we can do about it? You kind of immediately, as somebody who's been teaching corporate finance for many years, ask yourself, why are they getting into all this trouble? You usually get into trouble when you can't pay your debt. So why do they have so much debt? I started asking. From JP Morgan Chase, I want to just tell a little incident much closer to home. A bank, our too big to fail bank, right here. Maybe the CEO is here, that would be interesting. Stumpf, the CEO of Wells Fargo Bank, where I actually bank. In a June interview in Financial Times, and where I'm going with this is, as I started getting interested, I looked at the banks and the policy and what was going on and the crisis and all the narratives after the crisis about why and what to do. I started listening more to what they say. And that's the title of the book. Bankers' New Clothes refers to flawed claims that people make, to things people say and get away with saying that are just wrong in various ways, sometimes just completely false off the bad. And sometimes they're just more subtly flawed, misleading, whatever. So let me give you an example. This one is, I couldn't sort of come up with it. I'm sure it was a slip, but I did ask the reporter many times, did you really say that? And did you really not question him about that? Here was a story, front page of the Financial Times on early June of this year. Wells CEO, I actually had it printed out just to remember, but I remember it almost by heart. CEO is critical of banking regulation, of regulators' proposal to force the banks to use more long-term debt funding. Oh, no. He can't do that. That's expensive to fund. You got to go to investors. That's hard, he says. In the interview, he makes the following statement. We in Wells Fargo Bank have a lot of self-funded, he said, deposits. And now comes the statement. Listen carefully if you can catch the problem. And therefore, he said, we don't have a lot of debt. Find the flaw. It was probably a slip, but he kind of momentarily forgot that he owes me that money that I gave him. He does. It appears on his liabilities. It's a revealing slip because that's part of what's going on. Easy money walks in the door every day and gives them money that they, we hope, make loans with or do something useful with, but they'll do what they'll do. They love return on equity, they'll go to derivative markets in London, with excess deposits. If you talk about what JP Morgan Chase does, back to JP Morgan, well, this is more of a mortgage kind of bank, but JP Morgan is one of those players in lots of markets, in derivative markets, commodities market, you name it, they're there. It's a universal bank, you know, these balance sheets, you have never seen anything like that, never. The top 80 corporations in the world by asset side, all banks, financial institutions. JP Morgan Chase is just about the largest corporation in the world, depending on whose accounting system you use. Matters a lot to that bank because they have a lot of derivatives that are treated differently in different accounting systems. In any case, JP Morgan Chase gets $1.2 trillion in derivatives, they have more in derivatives, $1.2 trillion in deposits. And what they define as loans on their balance sheet is $700 billion. The next time the bank CEO says, if you touch me, I won't lend, however you define lending, he's not looking for money to lend. That's not his problem. His problem is what he wants to do with the money and his profits and all of that. So that's a whole different problem. But it's not the regulation that's stopping him from lending. Okay, so that's kind of right there. We got a few policies off. If you read the papers, of course, you're going to hear that the topic that I'm interested in, which is called capital regulation, you might think that what the debate is about cash reserves, because the banks are said to set aside capital. So when you hear about stress tests, or when you hear about this whole debate about capital and Basel and all of that, you think that it's about this money they set aside, and their lobbying will tell you that it's money sucked out of the economy that can't be used. Well, for us in Silicon Valley, we know that funding with equity, venture capital, private equity, whatever, does not stop you from investing, and it's not a rainy day fund. It's not a cash reserve. So right off there, you're not even talking about, you're confusing the sides of the balance sheet, you're not recognizing that deposits are your debt because they're self-funded only because I have other things to do with my time than to be a normal creditor. And so there you have the banks having enormous numbers of creditors, all of us, who are letting them, who are trusting the FDIC and the other regulators to keep them in check. That's half of what I have to say, right there. From then on, you're in what's called, in a recent research paper, a leverage ratchet. By the time you have a lot of debt, you prefer to keep borrowing. The homeowner might also take a second mortgage, and they will not prepay the mortgage once the debt is in place. By the time you start having a lot of debt like the banks do, and we're talking above 90% debt, they're allowed to have even more. The regulations that we're talking about allow them to have only single-digit number of, a fraction of equity to the total. 5%, 6%, we're arguing in those ranges. Basel III, the big reform, 3% equity. 3%. The rest is something about equity to risk-weighted assets. Those risk weights give zero weight, as if it's as good as cash, to AAA security, sovereign debt within Europe. The Cyprus banks could have satisfied, probably did, satisfy Basel requirements. Their debt was in Greek debt, that they were promising depositors 4% and turning around and getting 15% from Greece. Wonderful spread until, oops, the 15% is there for a reason. Greek debt is not as safe as cash, and it wasn't. They lost 75% on that, and somebody had to bear those losses. The Cyprus banks did not have anybody to go to for that. So some of their depositors had to, which also happened in this country above insurance. And some European taxpayers also had to deal with it. The same depositors, by the way, in banks in Germany that only got 0.5%, didn't even get the 4.5% that Cyprus banks were paying these Russian oligarchs as well as their own citizens. So what's wrong with banking? Too much debt, way too much debt. What they say about why they need to borrow so much, that's banking, all of that. I don't have the time to explain, but that's what the book and a lot of related papers around it, explained at different levels. There's absolutely nothing to recommend these levels. One of the smell tests you can use is you don't see that without any regulation anywhere in the economy. You don't see corporations that borrow so much, even though there's a tax advantage to borrowing, even though we don't regulate. If you can find somebody to lend to you, you can borrow as much as you want. Yet, we have equity-rich corporations all over. By market value, US corporations have 70% in equity. And the most popular way to fund investment is retained earnings. Perfectly good equity money, on-board money, that you can plow back into the business that Warren Buffett does all the time. He doesn't ever pay out. Nothing's stopping the banks from just retaining their earnings, making loans, backing up their liabilities. Yet, they need to return capital. Going back 5 years, and then I don't have no idea what time I'm okay? A couple more minutes. Go back to 5 years. What happened 5 years ago? And that will tell you a little bit more about where we are on the regulation. 2006 was a great year for banks. Wonderful years. If you go back, glowing. Bear Stearns, Lehman were celebrating their record earnings in 2006, paying hundreds of thousands of dollars to average employee, paying dividends. Between 2006 and 2008, the largest 19 US banks paid in just dividends. I'm not talking about bonuses, just salaries. We're not going there. $131 billion were paid out. They left the balance sheet out. $131 billion. This includes almost $80 billion paid after the summer of 2007, when there was already clear trouble in subprime mortgages. Who allowed that? The Fed allowed that. They were allowed to pay out $80 billion through 2008. We're talking through the fall of 2008. We're talking the government is investing in the banks, and they're paying the money out. TARP, Troubled Asset Relief Program. Among the other things, they had this capital purchase where they recapitalized the bank. How did they recapitalize the banks? They invested in these same 19 banks. That's the banks that had the stress test in 2009. $160 billion. Right in the fall, 2008, and maybe early 2009, but I think most of it in 2008, while the banks were paying out dividends at the same time, and essentially replacing the money they had just paid out. And how did they pay them the money? Essentially in debt. It was preferred, it was junior debt. The government doesn't like to take equity position in banks. So what they did was they gave the money at certain interest that was going to be jacked up and some warrants, and never mind all the terms. And there were some strings attached. In early 2009, the government, Treasury, which invested this in the banks, behaved like a normal creditor and said, stop the dividends to the other people, pay us first. Politically, it would be terrible not to get paid on TARP. And restricted bonuses too. Ooh, the banks didn't like that. So did they want to lend the money? No, they wanted to pay it back as soon as possible, and those that could did. So fine, so it was a round trip for us. We lost a little bit, not that much. Did we gain much? It's not clear. And that's the legacy. The legacy was, of all of this, and all the bailouts and all the supports, that everybody learned was, if you're bigger than Lehman, they're going to be afraid to let you fail. And I'm involved in the effort to try to make that fail option credible. That's what they want you to think, that we got FDIC as authority. FDIC did not have authority for Lehman. So Lehman either had to be bailed out, like Bear Stearns, essentially. We can talk about Bear Stearns, that was a whole episode in March 2008, or allowed to go into bankruptcy. Well, the cynic would say FUD was not as popular with the people involved, or they claimed they didn't have the legal authority to bail him out because it was an investment bank, as Bear Stearns was, that they arranged this stage to JP Morgan. And they let him fail. Well, the bankruptcy lawyer said the whole world suffered. Who knows? We can talk about all the contagion mechanisms that have erupted in the fall of 2008, 5 years ago, just exactly, and what happened in the narrative since then that my ex-colleague Ben Bernanke likes to tell you about it, which is we saved you from worse. Great. And what are they doing now? He's allowing payout again for these banks. They can invest that money. They can do anything but pay it out. They should be stronger. Banks in Europe right now are in miserable shape. The ECB might take a look if they dare. But if they dare, what's going to happen then? Who's going to save these Spanish banks? The Spanish government wants these banks to lend to them so they can all fail at the same time. Europe is a mess. So where trouble is going to come next, I don't know. Whether we'll have a financial crisis and when and how it would come about, I don't know. But my point is the following about the banking system, and I'll end here. Without an acute crisis, this system is incredibly inefficient and incredibly distorted. And it has banks that are too big to fail. Banks that are too big to fail are truly among the most distorted things in the economy. And I think everybody intuitively understands that is a license to do whatever you want, essentially. And we see the results. These banks are reckless, basically. They get cheap funding. Creditors, not just depositors, other creditors, don't worry very much about the risk. They basically think. They get collaterals, all of that. I tell my friends in the FDIC, in an event, you won't find any assets because all these collaterals also exempt from bankruptcy. They can walk off with it. So they have derivatives and repos and all these other things. But the fortress balance sheet is not a fortress. Commitments off this balance sheet are massive. Derivatives are massive. You don't want to see that. You don't want to go there. If you want a system, the system has to be resilient. There's nothing stopping them from making loans with equity money. They're completely the wrong number of digits on the fraction of equity, entirely wrong. The whole approach is let's just have enough. Let's have a stress test. We can talk about stress tests. I don't have time. But I'm going to end here. Every day, these banks are not making some loans that they don't feel like making because they're a little bit too boring for them. What they like is high risk, high return stuff. They come from a sort of debt overhang where the homeowner won't invest in the house because it's kind of potentially belong to the creditor. They're not going to give a gift to FDIC by making the boring business loan. They prefer to do something else. So the economy is dragged down from unhealthy banks. And if they recover, they're the first to recover. So recovery is mostly accrued to the banks because when you're highly leveraged, a little bit of profits is a lot of profits. When interest rates are low, they do well. I'm going to end here.
Thank you. Let's start, if the general prescription is insufficient levels of equity capitalization, let's start with where should we be? For a very large, arguably systemic bank, what is an appropriate level of equity capitalization?
I'm often asked that, and when I don't have like a model and tables and numbers and estimates and a dynamic, general, stochastic equilibrium model with stuff like they produce in Basel, I'm told that somehow I don't have a right to speak. But I've looked at all the papers that support the numbers, and they're all flawed. So where should we be, to your question? I go to that figure of 20 to 30% for the following two benchmark reasons. First of all, we hardly see healthy corporations run with less than 20, 30%. Banks wouldn't lend to such corporations usually, to such businesses that have very little equity. Banks themselves, if you go to the history of banks, used to have that. If you go back to the 19th century and then you go into the early 20th century, banks were private partnerships with unlimited liability and 50% equity. That's 19th century. Then they become corporations. Even in the US, they don't have limited liability and they have 20, 30% equity. And they're fragile for other reasons. They can't diversify, they don't have a central bank, then they do have a central bank, they have deposit insurance. The more safety net, the less equity. So where I am going, which I won't get there, so I'm just meaning to say a lot more than the numbers you're talking about, is in our book, we have a proposal for maintaining equity between 20 and 30%. When they respond to that, they say, oh, that means I need trillions more equity. Not necessarily, because I don't mind that they shrink some. That's fine. Some of what they do, other people can do. You don't have to have it under the same roof. There are no economies of scale at the scale that they are in. They are probably unmanageable at this scale. Even Jamie Dimon couldn't control the London whale. So let's not talk about governance of these. 20 to 30% is something you can get to, and if it means that we have to have less big banks or less banking, that's also fine. In other words, in Europe in particular, and possibly in this country, we may have excess capacity in this industry. It may not be the right size of industry relative to GDP or whatever. We may do all better with a little bit less banking. And let 1,000 other stuff bloom. I don't care about the hedge funds or the non-systemic institutions. That's fine. It doesn't all have to be within the bank.
And without arguing who's the beneficiary, if you had higher levels of equity capitalization, arguably you'd have a shrunk down bank to some degree, less commercial activity supported by the bank.
Yeah.
And in the event of a crisis, the equity shareholders would suffer. The alternative is a heavily debt capitalized financial institution subject to these too big to fail regulation. There, the loser in the bad scenario is the distributed general population. So without arguing the benefits of concentrated losses amongst the equity holders versus distributed losses across the population, just in terms of economic value, do you think we are better off with that more equitized, smaller system or with the larger banking system?
We're definitely better off because who benefits from the system is very, very, very few people. We're talking about just redistributing the risk. And the shareholders right now are getting all the upside. The taxpayers who are bearing, and the public who are harmed from the distress itself, let alone failure, are getting the lowest deal. But in any case, it's within the system. The end investors, the diversified investors, have lost massively in the crisis. On their other holdings, lost some jobs. The economy had a recession that was magnified by the weakness of the banks. So it's all in the system. It's all of us. Essentially, what makes the banks love equity so much in terms of their total funding cost, because the depositors and the other creditors is also us in the end, is subsidies that effectively are captured by shareholders, by the narrow shareholders of the bank. Well, imagine then, between the bank with 20 or 30% and the bank with 5%, imagine that what we're talking about is producing dye, and you have a clean process and a polluting process. The more debt, the more pollution, call it systemic risk. Systemic risk means that your distress is harmful to others, or the failure to the system. You're not only dysfunctional as a corporation, you also get your counterparties nervous, and you might fail them in a chain reaction or in all kinds of contagion mechanisms in the process of trying to deal with your debt and unwind them, or have everybody run off from you in the fear that they will be touched. Nothing about the instability is healthy for the economy. The economy benefits from stable banks that can sort of withstand that can keep lending in a downturn, that are making appropriate profits and charging appropriate amounts for loans, and living like that. So my answer is clear. Very, very few people benefit from this system, and virtually everybody, almost all people, suffer from it.
So in spite of the protests by the bankers about the impositions on them from Dodd-Frank and from Basel III, et cetera, ironically, you'd suggest that those are actually, that urge to regulate and allow the bank to continue to live close to the edge is really a shadow partnership with
government,
between the government and the banking system, rather than an effective safeguard mechanism.
Yeah, I mean, Dodd-Frank, you touched on, I didn't, in terms of the scene, there are lots of commissions everywhere, Lehman Commission, Vickers Commission, lots of commissions. We have Dodd-Frank in this country. It's a massive, massive law that's in the process of being implemented, which is a messy sort of rules-making process with, some of these have to be agreed on by 7 regulators and some by 4, and, on and on and on. And so a majority of it was not actually put into place, and there's comment periods of everything, and everybody submits thousands of letters, and the regulators have to read them all, and then they have to right? And there's Volcker rule, let's not forget. Some of the law is a mess, and there are different parts of it can keep us here longer. My focus was on sort of the Title I, Title II game. Title I is the sort of prudential supervision of the banks. It's supposed to be the prevention part, the keeping them, on track.
But actually encourages them.
Well, if it's not implemented correctly, the point is that Title I, my big claim is that Title I is not effectively implemented. In other words, that what the regulators are doing is back to the same things they were doing before with some small tweaks. And they're maintaining some of the same system that's failed before and not doing what they can do. So they have every authority to stop the dividends, and yet they allow them, for example. Title II is a resolution. Well, the FDIC is doing a great job on that, but what will they be left if it's ever triggered? So when you look at how it's going to be triggered and all that. My answer, short answer to you is, capital regulation uniquely is extremely valuable to the society and even privately to the banks. Because our recent paper shows that just like the other frictions that high indebtedness, high leverage creates, if you could get the creditors and the shareholders together, they would commit together to having less debt and more equity. But in the ratchet, in the addiction to borrowing, the bankers themselves, and to some extent some of their most important shareholders, at least the ones that are concentrated in the banks, are tempted to take advantage of the guarantees and compete with each other to extract more subsidies out of the rest of us. But that's just
that's where the leverage ratchet.
That's where the leverage ratchet comes. You become addicted, and if the creditors don't push back, you just keep doing it. So the only pushback is the regulator. The regulator can get them effectively to commit not to be as dangerous, and therefore to be in a better position to take advantage of profitable loans that come their way, as opposed to leave them by the wayside, and not to take excessive risks that are potentially unproductive, and maybe even have better motivation to control their own traders. Because the more of the losses would come to shareholders, and maybe the shareholders will be more insistent on risk governance than they are right now, because the incentives now are, to take advantage of these guarantees naturally, and to take advantage of the easy terms of credit that you can get. That's easy access to funding.
Since the publication of the book, you've been speaking around the country to this topic. You've obviously gotten a lot of inbound inquiry. What's your sense of what it would take to catalyze change?
Well, on these things change all the time, and there are lots of capital regulation and other regulations, of course, are done by nationals. In other words, they're done in each country separately. Of course, the banks come and lobby that you can't regulate here because the other guy is not regulating. This champions level playing field for flawed arguments. We don't accept it for pollution, but why should we accept it here? If somebody else allows, why should we? In the US, we have a new Fed chair woman, I think, if she's confirmed coming, and we'll see what happens. Right now, they're trying to decide that. I'm not happy with what they are proposing, which is still open on the largest banks. 5% for bank holding companies, 6% for depositor institution. Not enough. In Europe, it's worse. In Europe, because the governments in Europe are so needy of the banks and in so much symbiosis with these banks, they are even worse at regulating them than we are. They have been. Banks in Europe have gotten into enormous trouble, and they are probably a number of them that are insolvent, sort of zombies like savings and loans became. Very dysfunctional banks, not making loans in various countries. So it's an uphill battle, basically. When in 2010, one of my colleagues here, I won't mention the name, he might not want, in this institution, said to me when he heard what I was doing, you'll be in good shape next crisis. Too late for the last one. In other words, we missed the opportunity because we only do things after crisis. So what's a crisis? So my co-author always says, but we're not out of this crisis in Europe yet. In other words, Europe really hasn't recovered and might be going straight into another crisis with sovereign debt or with politics of ECB or whatever. It doesn't have the right digits, but there are a number of champions of of capital, even within the regulators. There is Tom Honig in the FDIC. There is some people in the Bank of England, although the governor, who was among my best friends, has stepped down, Marvin King. And I am talking with him in New York in a couple of weeks. And he endorsed the book. Philip Hildenbrand was in the bank, in the Swiss National Bank, and Swiss people and some Swiss people in Sweden are more sympathetic. But what we take on in this book is sort of a way banks got used to thinking about things, and there are a lot of entrenched ways that they think, which I find shocking sometimes in what they are. But it's sort of a rabbit hole when you step in there. What it would take to change is a whole lot of people, if they want to know, because there's this phenomena of willful blindness. In other words, I'm not going to look. Don't tell me about it. I got my story and I'm going to say it. I don't know. So it depends relative to what you counted. Have we been successful? We stirred some debate. Some people have learned. Some regulators are listening. I went to a big conference of deposit insurance corporations in Asia and Indonesia, and they bought 600 books. So that was good. On the other hand, there are some regulators that refuse to engage, literally.
Globally, is there a national banking system that you'd point to as a model of effective governance? I have an interesting story about that from that same trip to Indonesia. Because I've been asked this question. Occasionally I come across, there's better and worse. None of them is like I can really point to as the model. I was in Denmark recently, and they got their Danske and their Norges and all of that. So every country's got their big banks and their politics. But just an interesting story is, in Indonesia, in this conference, was a central banker from the country of Croatia. I did not know anything about Croatia. Croatia is in the European Union, but they have their own currency. And I didn't know anything about them, never heard of any trouble there, I've never heard of anything good. But when he showed some of his pictures, it turned out that Croatia has come out almost virtually unscathed. Now, it's not about capital regulation, interestingly, because in Croatia, and this is part of the problem that they have in Europe, the European Union, the European Treaty allows banks to do branches in other countries. And so what you had, for example, Iceland crisis, the Icelandic banks went to open branches in London and in Amsterdam. And when they refused to pay the depositors, these governments stepped in and paid, and they're still suing Iceland for that. Now in Croatia, they have foreign banks. 80% of the banks in the country are the same Deutsche Bank and BNP and all of those European banks. Open a branch there. And the central bank of Croatia cannot really control those banks very much. But what was interesting about this presentation was he was a regulator who knew what he wanted, and he did not want them to get into kind of a overheated sort of housing bubble or excessive credit bubble or any of that. And so that central bank had very few tools, but they had some. And in the country, they had sort of taxing authority, and the central bank had some kind of regulatory authority on reserves. They could control the exchange of the money to their currency and all kinds of other things. And they gave the banks a whole bunch of tax effects to contain them and control them, and I guess keep them capitalized in their currency in that country somehow. And so I'm not sure all the tricks, but it was clear that they basically used the tools at their disposal to to protect their citizens from banks, which is really what it's about. It's about, can an industry harm by taking risk? We have that in other industries. We have that in any industry that has to do with safety, airlines, whatever. The risk in banking, though, is a little bit abstract, so you don't quite see the inefficiencies. That there's no people dropping off airplanes or something, so it's a little bit harder to put your hand on the damage. It's very broad and very small, as social damage from inefficient banking. That's why sometimes I get desperate, because it's like, will you
I watched Frontline on NFL denying, concussion or something. Eventually there were enough brain research, and eventually, tobacco industry or NFL, learn that something's harm, and that we need to regulate certain things, selling tobacco to kids or kids playing football, whatever. Will we learn, can we, in banking, you always have a story. There's a crisis, you can say, oh, they're like earthquakes. Banking is inherently fragile, prepare the ambulances in the corners, prepare your resolution, please let us fail, and you don't have the stark choice. I'm talking about prevention, putting the speed limits. So back to the question on numbers, I gave a talk on Friday in a conference on cost benefits of regulation, and they wanted quantitative analysis. This is Eric Posner in the University of Chicago. They want cost benefit, this whole thing about cost benefit. I said, I want to come, but I don't have cost benefit. What I do know is the following. The trade-offs of too much equity, the trade-offs, are not going to kick for a long time at this point from where we are. And the analogy is speed limits for trucks, loaded trucks in a residential neighborhood. Without complicated models, that 90 miles an hour is not safe. You look around and say, is there anybody can justify to me living on 3% equity as on a regular basis? It's just not a place to be for a corporation that has access to equity markets and all of that. Start getting better, and we'll see where we stop. We've got plenty of, raise equity if you can't, that's my stress test. You failed my stress test, etc. Reducing speed from 90 to 50. Whatever trade-offs about driving too slowly don't quite hit you. So I know what to do from 3% or 5%. And that's I guess Croatia was the start of this question. Croatia did it well.
Let's open it up to questions, and I'll point out. Please, over here.
When you describe Croatia, it's almost like you described a local bank. They made all the big banks into local banks. And I wondered if you could give an opinion about local banking versus big banking. I know that young people have trouble getting mortgages from big banks, where if they've done some sort of business, they're doing a business in a local city, the local banks can bank them and check on them every month and see how things are going. And I wondered if that's where we're going to go, and what you think about that.
This is a great question, because we now have global banks, and they tell you that they must be global and they are a one-stop shop in big supermarkets. But you're pointing to something about banking, that there is something about it that's local. Because when you lend, you're supposed to do creditworthiness analysis. The local village lender knows the people, and sort of that's the local banker in a village that doesn't have banking. So oftentimes you will hear that people can't get loans, businesses can't get loans. I have a friend I work with, she has a small business, she can't get a loan, her business is all equity owned and she doesn't have a record. The bank would seem to lend to her only if they can get the Small Business Administration to guarantee it, so they don't want to take any risk on lending at all. But they're behaving like distressed borrowers themselves, the banks. They want to go for the derivative trading instead. So small banks can get into trouble as well. Savings and loans were small. So cajas in Spain are small. So risk in banking, harmful risk can come from everywhere. A lot of small banks failing at the same time, or an AIG that just sucked some risk out of the banking system and allowed them to keep speeding. So, but I say, if the banks don't like to have more equity and they keep saying, let me fail, then I would question, if you want to step out of the box, I would question that they should actually be global corporations. They can have connections with other corporations elsewhere, but the fact that the bank is global, in Lehman's case, it really interferes with the ability to fail, because they fail legally in every country. So they exist globally while they're alive, but they fail in courts, in every court. And we are nowhere on the resolution, we're nowhere in cross-border resolution. Even within Europe, they're trying, but even within Europe, there are different insolvency laws and all of that. So Lehman Brothers, bankruptcy, overnight the money left London. When the London bankruptcy process came in, they didn't have money to turn on the lights. So the subsidiary of Lehman in London was empty of cash, didn't have any money. So the corporations globally can move the money around, but I'm digressing. So local banking has a future. Again, you want them stronger. You want them to have owners' money more in line with, in this country, we have a lot of community banks, but I'm not sure the community banks are so efficient either. They might be a subscale size, every corner having a bank, 7,000 banks. So there's probably an efficient scale of banking somehow, and they should have local branches and maybe be concentrated. How global banking should be, it's not clear.
Rick, wait for the mic if you would.
So I'm a little surprised, Anat, that you're so focused on capital requirements instead of the nature of the bank's asset portfolio, because the two really do interact considerably.
Yes.
That is, if in fact all you were doing were taking demand deposits and making commercial loans and not making speculative investments of the type that banks make, you wouldn't need such a high capital requirement. And particularly because notwithstanding your criticism of what the JP Morgan guy said, demand deposits are different from let's say, corporate debt. Corporate debt has to be repaid when the time limit hits, whether you refinance it or simply pay it back. But demand deposits are extremely sticky. I mean, people don't pull their money out of the bank except in a panic. So in truth, there's low risk of a run on the bank. There would be plenty of reason with a relatively safe portfolio of assets. The old-fashioned commercial bank was a profitable business. The government guarantees the demand deposits. You get money cheaply. You lend it out fairly cheaply. You make a spread, and it's a decent business. What's happened, I would say, the biggest distortion is not the capital requirements, but the nature of the asset portfolios, which has become, banks have become investment banks. They've become traders. And that's my, what do you think about that?
Great question, and you cover a lot of things. So let me say a few things about that. First of all, deposits are sticky because it's kind of a hassle to change bank and because we're insured. However, the bank should be solvent, so it can have liquidity supports, but the issue is the losses. Now, banks are subject not just to credit risk, and they need to make good loans to not have too much losses, on houses and others, but also to interest rate risk. So savings and loans failed on interest rate risk. And what happened there partly touches on another point, which is part of the answer to your question. So-called shadow banking systems. So what happened then was, money market funds. So think money market funds. Money market funds were born out of Regulation Q, which prohibited interest in banks, and they were going to pay more interest and be like banks. So from the beginning, they were competing with these small banks. And where I'm going is that investors want returns and want yield. And so what you end up with is Lehman Brothers was a pure investment bank. So I agree that one of the advantages of maybe breaking up structurally is to have different capital regulations for different parts of, as opposed to, the bank holding company, and they do all kinds of things. And they actually indeed put the derivatives into the insured subsidiary of the bank. So definitely, I'm focusing on indebtedness, and that's why all these numbers should be taken with a grain of salt, because when I say 20 to 30%, it's all risk-based in principle. So the point is a lot more, but I need to give numbers so that they don't tell me tripling, to which Martin Wolf said tripling zero, doesn't get you very far. So it was 2% to risk-weighted assets. They changed to 7% to risk-weighted assets. Well, it's not very much anyway. So when you start with nothing, they always say relative to before, so many percents relative to before. Well, the numbers. So we have to consider relative to where you can be, should be, why not? So the answer is yes. Derivatives, what's changed that you're touching on is the scalability of the risk. They take a little bit and they magnify it. So that is harder to do with simple loans. The scalability of derivatives and the securitization and other things that they could just take a little spread and make it on volume, if you will. So in that sense, so my answer is both that there are risks in traditional banking as well that we need to watch for. And there could be, housing and commercial estate, real estate bubbles, as well as interest rate fluctuations that would bring traditional risks into banking. That's always been there for small and large banks. Then you go into the sort of hedge fund business of banking, and now you have the scalability issue. In that sense, I would put anybody like an investment bank that is sort of potentially systemic in the sense that they're interconnected with others because their single counterparty exposures are enormous. And when they complain about the restrictions on them, it only shows you how interconnected they are, that they can't stand, that they have so much interconnected to one counterparty that if that counterparty fails, they're kind of, in miserable shape. I would put very high capital requirements on those because they don't even have deposits. So the ones that start with deposits, fine, so they should have 15% in my book. Why not? 20%, 15. Depending again. So, but it's less important. Maybe 10 is enough. If you had them split, then I'd put 40, 50%. I mean, let them not play with because what they do also is they have this really fragile repo debt and commercial paper and other things. So it's very hard to control that short-term runnable debt. The money market funds, by the way, that's another failure of the regulation. I mean, complete failure. The money market funds just lobby to be regulated by the SEC, which does very little to regulate them. In my book, they're a bank. If there is a checkbook, it's a bank. If they promise $1, it's a bank, should be regulated like a bank. They started competing with banks, and they act like banks that don't pay deposit insurance. What happens with them is they're another layer of fragility. They pull out from the people they fund, and their investors pull out of them straight into insured deposits is what happened in the crisis. All of a sudden, banks had a lot more insured deposits. That helped their liquidity problem because they could just use that to pay, but it created a lot of fragilities down the chain of. So there's a lot of problems in this system, but sorting out the risk and not creating too much of an interconnectedness in another system with lots of little pieces is challenging.
Over here.
What are your thoughts on contingent capital? Might that be an effective tool to think about equity requirements and capital requirements?
I'm negative on contingent capital. Contingent capital is a manifestation of the intense hate of equity in banking. There is nothing to recommend contingent capital over equity. None. They get, in the US, contingent capital, which is essentially debt that magically converts to equity in just some trigger.
Is this bail-in?
Bail-in is, so here's just the starting point when you think about this. This is debt. This is long-term debt. This is nothing with business of banking. This is not deposit. It's not short. It's just a bond, okay? It's a bond. Now, every unsecured, it's unsecured. In other words, it's debt in some prioritization of debt. And it is, no, let's just step back. Every debt in banking, it's an amazing concept that debt holders would lose. But in every bank, in every company, debt is a loss absorbent in default, right? I mean, let's just start there. Debt is paid as long as the borrower can pay, or whatever is left. That's debt, okay? Or however they stand on the line for normal companies. That is debt. So banks now want to have, as long as they promise to pay. So it's debt. This way, they postpone the loss absorption to some other day, okay? Now, how will that creditor bear losses. Something has to be triggered or something has to happen for that particular investor to bear losses. My question is, why not put equity in place of that? What's wrong with equity? If you want to absorb losses, put equity. We have equity, and we have the rest of what the bank does. If we want safety and loss absorption, and we want to prevent and avoid the distortion of high leverage, and it includes overhangs, anything, including contingent capital, even preferred, is overhanging. Overhanging from the perspective of the decision maker, because it's got to be paid before they get paid. That distorts investment decisions in general. The gold standard of the investment decision is somebody making investment with their own money. So the gold standard is 100% equity company, except for the governance between managers and shareholders. But in terms of the alignment and not having creditor-shareholder conflict, banks can't be there, so they start with a lot of debt because of deposits. COCOs, nobody has convinced me, have any advantage over equity in the same time that you put them in. In other words, instead of putting in a COCO, put in equity right then. There has not been one argument to justify all the hybrids against equity, and I will say more. In the crisis, no tier 2 capital, no capital that was hybrids suffered any losses. Everybody who was promised was paid. Nobody that was meant to absorb losses did, even bailed out banks. So, no, not in any way that we know about in corporate finance, no. Because when you put it in, if it's going to absorb losses, it changes the risk distribution. So as long as the risk is borne, we have a theorem about that, a conservation of value. And in the US, they don't even get tax deduction because it's not defined as debt because it doesn't have creditor's right. In Europe, they give a tax deduction. Every time you promise, you get a deduction of your interest. But if they don't have tax deduction, no. If they really do absorb the losses, then balance sheet absorbs the losses and funding costs are not changed. That's the basic sort of physics of finance on that. And it's a fallacy to say that it's cheaper. So it's not. A funding mix with equity, COCO's debt, has the same cost of funding as equity debt. So there's nothing cheaper
So we'll
about
take
this.
one quick question and one quick answer. Wait for the microphone, if you would. Right here.
I have a quick question on Canadian banks. I'm not sure if you have any thoughts on that. So generally speaking, I heard that Canadian banks, they are more prudent. They are focusing more on traditional commercial banking activities and less risk-taking. So do you think going forward that the business model of Canadian bank will be a good model for the US banks? Thanks.
I'll try to give a short answer to that. I was kind of curious about Canadian banks. It seems as if it's sort of path dependent. How the U.S. banking system started, it's so scattered and so it has a lot of different kinds of banks, state banks, different kinds of institutions, whereas Canada has national banks from the start, no state barriers or anything that we used to have, and very few of them. So it's a real oligopoly over there. And so they're very, in that sense, they're sort of big, and they have more, you could call it charter value in the sense, and you could consider charter value as sort of as an implicit equity. In other words, they have something to lose there. But it's also kind of a subsidy. So it's not clear. Canadian banks didn't do as well as people think they did. We didn't hear as much about them as the U.S. banks as the European banks. They didn't get in as much trouble. And so Carney gets lots of credit for not getting as much in the news, although when you read more closely, they had a share of trouble as well. Canada always had more stable banking, but some people claim that the US has a more vibrant financial system in general. In other words, we have more equity markets also than in Europe that are active here, more forms of funding. So we're not as bank reliant in this country, and that's good. We shouldn't allow the banks, especially not the big banks, to kind of take over the country. They are growing, and we should stop that. So there might be some lessons from Canada, but I think it's it's not in the offing to become like Canada here. We just have a slightly different system. But yeah, it's interesting that they are more stable, have been over the years.
Anat, thank you. Thanks very much.